welcome to this week's episode of We Got You Covered on RVN TV. I'm your host, Rob Shestack, and with us today we have a really good friend of mine, Shay Cowan, and each week we come to you and we talk about different topics relative to employee benefits and insurance. And this week we're going to be talking about self-funding of health programs and insurance captives. And Shay is one of the foremost experts in this area. Just to give you a little bit of background from Shay, he graduated with a degree in business marketing from New England College. He has 30 years experience in this in the employee benefits space. He was vice president of HRH, and he has been, for the last 16 years, a principal with Katz, Pierz, which is a local Cherry Hill insurance consulting firm.
Correct,
Shay,
yeah.
Welcome to the show.
Rob, thank you very
coming.
much for having me come out.
You're welcome. So today, I usually like to go over a couple of statistics, and I want the audience to know that 61% of today's workforce are actually covered by a self-insured healthcare plan. And most of those employees probably don't even realize they're covered under a self-insured plan. So it's kind of blind to them, but we're going to go into specifics on what that really is and how that works. And if we look at 20 years ago, about 40% of employers had a self-insured health plan arrangement. So that has gone over 44% over the last 20 years. And the top three reasons why employers self-fund their health care, and you're going to get into what all that means, is cost savings, increased flexibility, and control of the plan, and enhanced cash flow, which is very important for companies today. So we're going to start out. And Shay, can you explain to us what exactly is self-funding of healthcare? Because it kind of sounds crazy. You know, we're used to talking about Aetna and Blue Cross and United Healthcare and all these insurance carriers, but what is self-funding of healthcare and how does it work?
Okay, I'm going to go back because you brought up some really good points. And first of all, we've seen great growth in the self-insured side, and I think you're going to continue to see that more. I feel that us being in the Northeast here is probably the last frontier holding on to the fully insured side. And if we went to the Midwest or West, we'd see a lot more of the population going self-insured. There's reasons why that trend is going that way. I've been doing this now for 30 years, and one of the biggest questions people ask me is, how often do people go into a self-insured model for healthcare and then go back to fully insured? And I love that question because in 30 years I haven't had anybody go back. So if that isn't just telling you the ability to go in there, to be able to take control of your own plan, and that in itself, I don't know what isn't. So what is self-insured? Well, if you think today in insurance, you pretty much take a premium, and that's $1. Let's just use $1 for example, and you slide that across the table and you're done. You bought a plan, be it the Blues, be it Aetna, be it United, whoever it may be. And when you go into self-insured, think about that $1 breaking down into 4 quarters. You're going to pay one for the administration, and then you're going to pay a little bit more for stop loss, and I'll get into what that is. And the rest of it's funding your claims. So as an employer, they have to look at their population and say, boy, every year we just get an increase, we dilute the benefits, we charge more. Is this the right routine that we're on? If we go into a self-insured model, I have to look at my population and think, okay, am I spending that full $1 that I'm sliding across the table every month? Or do I think that there's going to be some change left? And in its simplest form, that's really self-insured. Now, there's a lot of parts that we can break down on it, but self-insured is taking control and saying, hey, I don't want to pay that full $1. I think I'm only using 50 cents or 75 cents. And people jump into that program knowing that they probably are going to have reward hopping into self-insurance.
So typical insurance, I pay $1 to an insurance carrier, and if they end up paying out $1.30, that's on them. If they pay out 80 cents, they get to keep that profit. But I know that my cost is $1 each month per whatever.
Close, but not true. So any self-insured program has a risk-reward program. Otherwise, everybody would be self-insured. There'd be no downside to it. So our biggest hurdle convincing an employer to jump into that model is saying that today you pay that $1. Self-insured, your maximum exposure could be that $1.15 or $1.25, depending on that contract. However, the other example you used, if I only spend 80 cents, is that my only cost that I'm spending is 80 cents? So the answer is yes. There's a little bit more risk reward. you could possibly, in a really bad year, spend more. In a really good year, you could save a lot more. And I would say, in a 5-year period of time, 1 out of 5 years, they might actually wind up spending a little bit more had they been fully insured. But the other 4 years, they're savings, and it completely outweighs the 1 year that they might have had a little adverse risk selection for that year.
So what happens if I go self-insured and I have an employee that is really sick? And let's just say it's a pretty bad medical diagnosis, and it's $1 million, $2 million claim, which can happen
much
these
more
days,
likely these days, yeah.
right? Especially with the medical technologies that we have in the cost. So do I have protection? I understand that I can be self-insured and just pay all the claims and expenses, or I can do something what they call partial self-insurance, which I actually can buy stop-loss coverage. So can you explain that a little bit?
Yeah, I think the word self-insurance really, really scares employers. No one wants to take on that liability. We don't have a crystal ball to look into the unknown insurance. And you're right, whether it be cancer, whether it be a horrible illness, whether it be a transplant, whether it be prescriptions, which that's a whole nother topic of just how crazy they're getting in cost. An employer has to be able to hop into a self-insured program and put a stop loss, and you mentioned the word stop loss, which is really reinsurance. And what that is saying, look, we're going to put in, and for that extra part of that premium, we're going to put in that if you have that runaway claim, because we don't want you to be the hospital or anything, we want you to be the employer, make your widgets, and go about doing your business, and let us worry about if you do have that runaway claim, that there's going to be a threshold that they won't have to pay over. For example, it could be $25,000, could be $30,000, could be $50,000. It's really depending on the risks that that employer wants to take and the premium he wants to spend for that. But for an example, that individual in a given year, if they have that $1 million claim or $2 million claim, and they bought a $50,000 stop loss, they would be responsible from $1 to $50,000 and nothing over, whether it was $1 million, $2 million, $3 million, which is the protection to allow them to say, okay, I'm willing to jump into a program because based on my company, I might have 1 or 2 that run really high and have some stop losses, and I don't want to worry about them. I just want to worry about the majority of my group is healthy, and I'm going to be able to have that change on the table.
Now, what happens if I have 100 employees and each one has a $50,000 claim or $1 million claim? Unlikely, but let's just say it happens.
Yeah. So, great another example. So there's different levels of it. You have stop loss, which protects the individual, and then think of an umbrella, almost like your logo for your show, an umbrella covering the whole company's risk, and that's called an aggregate. So they're going to look at it 2 ways. So your example that you used, if everyone had $1 million claim, well, they'd only be liable for everyone up to the $50,000. So that would be their max exposure. But that's not the worry. The more likely scenario is what happens if they have several people that hit the 50, but a bunch of people that hit 40? That's a lot of risk and exposure for any employer to take on. So when you jump into a self-funded program, it protects you on the individual basis, and it also protects you as an umbrella, saying, look, this is the most you can spend in a given month, and if you exceed that towards the end of the year, forget about just really high stop-loss claims, think about just high bad experience. We're also going to put an umbrella under your group and say you'll never pay more than this, and that's that risk reward. It could be 15% over what they would spend on the fully insured world. And like you said, very highly unlikely, but it could happen.
You mentioned the word monthly, and that's important because if I have, say, these $40,000 claims all in January, even though I may have a plan that runs 12 months, what happens to my cash flow in that first month? Is there a protection that I have on a monthly basis as well, not just annual?
Yeah, there is. First of all, the first month is generally never the month you see a lot, only because even they could incur and happen. But in the self-insured world, what happens is there's a trail. That claim has to happen. The individual goes to the hospital. The hospital has to be able to bill, to get that bill together, send that bill to the administrator, make sure that they apply the network discount to it, send it back to be adjudicated. And we're seeing that in the industry, it's about a month to sometimes a 2-month turnaround time. So generally in the first couple of months, there's a cash flow advantage on self-insured. So it would be in the second or third month that they would have that issue that you were just referring to. And yes, there's monthly protection. So if it were one individual or two individuals, the individual stop loss would apply. If it were the company as a whole, it would say this is as much as you're liable for that month. In lesser months, we might try to recoup some back, never to exceed the annual amount. But that's what gives you that protection in doing so. You'll never have to lay out all that money and wait for it to come back. It will basically have monthly caps all the way out till the end of the year.
So if my aggregate limit is, say, $1.2 million for the year, I won't have to pay more than $100,000 in January, $200,000 as of February, $300,000
Perfect
of March.
example. Yep. So in the fourth month in, $400,000. So if you had more than $400,000, we would only ask to up for that amount, and then in lesser months we could recoup it. But if you never ever were able to have good experience after that, that would be that extra $100,000 per liability each month till the end of the year.
Now, are these plans governed under ERISA?
They are. One of the great things that I like most about self-insured New Jersey, we find ourselves in a very heavily mandated state, meaning some employers have to pay for things that make no sense for any of their employees. They have to because of all the mandates. When you go self-insured, you're complying with ERISA, which is basically federal guidelines of your healthcare plan. So they go through the same scrutiny of federal guidelines and COBRA and having to offer affordable and essential benefits and all of that. So it's not the wild, wild west. You're going to have a plan doc. Most take the plan doc of what they liked when they were fully insured, maybe make a couple tweaks to it, and they file that with a stop-loss carrier by saying, I understand that risk and I'll take it on, and there's a premium for that. So that plan runs accordingly on the ERISA guidelines from there.
Are there any disadvantages being self-insured?
You know, you're talking to somebody that sold it for 30 years, and I love it, so I'd say no. But the reality of it is a disadvantage would be being self-insured is having, you know, some bad years and running into a year that it cost more than had you been fully insured. But if you really stretch that out over a long period of time, I'd say it wouldn't be a disadvantage. I could sit here for hours and talk to you about all the advantages, and I would really struggle to come up with disadvantages. My only concern is the stop-loss market and the self-funded market has really come downstream. And what I mean by that, years ago that you referred to, it was all the Fortune 500 companies. It was larger employers that did it because it was just a win-win. We've seen it come way, way down and make sense. But when you get less than 100 employees, it can get pretty volatile. It can be, you know, even 150, which means you could have a couple really large months, and there's some disadvantages to the cash flow that you have to lay out that an employer doesn't want to do. And I know that you'll talk about it later, but there's new programs out there that actually help mitigate that risk as well.
Pretty cool. So let me ask you this question. So if it's almost like the stock market, right? The stock market's going up, it's going up, it's going up, everybody's excited about it. Then your stock goes down this 1 month and it's like, oh my God, the world's coming to an end. I have to sell the stock. So self-insurance is kind of like the same thing. I can have a really good year, a really good year, a really good year. Then I have that bad year, and all of a sudden the employer says, oh, this is a bad thing, I want to get out of it, but they're not understanding that they had 3 really good years. So when you go into this, you really have to look at it long term. It's not something, as you said, I'm going to go in it this year just to try it, and if I don't like it, then I'm going to go out of it next year. This is a long-term strategy.
Rob, on that note, yes, no, but let me turn the tables on you. You're fully insured. And I would question anybody that's fully insured for that same 3 to 5 years span. They have good year, good year, good year. What do they get? A small increase, maybe a small plan change, and then what happens in the really bad year? They get hit with a really big increase. Where are they left now? They're paying based on that for really high premium. What happens in the year after that? Now they have good experience again. Do you think the fully insured company is going to say, hey, you just had a blip 1 year, we're going to lower your premium? That doesn't happen. So in the scenario that you just talked about, those 3 years running really well, they get all the data. When I say they get all the data, they see how they're running and they understand what makes up the claims in their company. And in that bad year, not by names, but they know that, hey, we just had some shock claims, things that I don't see reoccurring, or maybe I can understand that. It's going to happen from time to time. And we're going to plan for it because it's not going to be, surprise, here's your renewal. react to it right now, and you're scrambling to go out to other carriers, deviate your plan, change your contribution structure. This is something that's happening throughout the year. An employer knows, we understand what's going on, and we're able to make informed decisions to not be able to be so reactive come that renewal. We're proactive, and we already know that we're going to handle it. And so I think it's still very different under the scenarios that you said for even that 5th year or 3rd year that was bad.
You know what, Shay, it's that time of the show we have to recognize our sponsors, but when we come back, we have a case study that you're going to share with everybody to show them how they save money. So you're on We Got You Covered. We're here with Shay Cowan of Katz, Pierz, and we'll be right back after we recognize our sponsors.
Shelter dogs aren't broken. They've simply experienced more life. If they were human, we would call them wise. They would be the ones with tales to tell and stories to write, the ones dealt a bad hand who responded with courage. Do not pity a shelter dog. Adopt one.
Say we've got grit, and we'll take it as a compliment. Because it's our uncommon drive, our spark within, that brings us together and sets us apart. We are temple made. And when others take shortcuts, when others take breaks, when others take the easy way, we take charge.
Welcome back to We Got You Covered on RBN TV. We're here with Shay Cowan of Katz, Pierz, and we're talking about self-insurance and insurance captives, self-funding of healthcare programs. And Shay, right before the break, we were talking about self-funding and the advantages and no disadvantages, but a lot of advantages. And we said before we had the break that we were going to go through a case study, and the case study, which we'll bring up on the screen in a second, will actually show how self-funding works and how an employer can save money. So if we can bring that up, and we'll go through this case study.
Yep. So it looks busy, but this is an actual case study of a group that we've had for over 20 years, and they spent the majority of the time fully insured. Owner didn't want to get involved, just paid the premium, and it finally got to a tipping point where they were faced with a 20% rate increase. They didn't understand how they got there, what data was supporting it, or so on, and they said enough is enough. And so we had moved them over to self-insured, partially self-insured. They were able to hop into it, and of course Murphy's Law, when they got into it, it blew up. And the reason I like this case study is it really shows the protection. When they had a bad year fully insured, they received a 20% rate increase on their premium. And if you look at their total premium, we're talking it was close to $2 million. That's a big number that any employer have to take on. So when they had a bad year self-insured, they only were able to get that increase on the stop loss, which was a small percentage of the overall premium. Because we were able to empower them with information on who had large claims and what was going on, and we realized that they were considered shock claims, most likely not to reoccur again, one and done type. They said, hey, we'll instead of taking a 12% increase on our stop loss, we'll take higher risk, a negative renewal, and knowing that they're not going to recur. And this example shows that they saved hundreds and hundreds of thousands of dollars because they were empowered with the data. They were able to go in there. They knew that they had a bad year, and they were able to put themselves back on track, save money. And this is just, this is an older case study. They've been able to show for years that they've saved millions of dollars of being able to do this. So even in the bad years, they had the protection of stop loss, so they didn't have to lay out the money. They had the data to show that they weren't going to have reoccurring claims, and they were able to be able to put their whole plan together, not have a contribution change, a plan change, a benefit change, nothing, and in the second year save a lot of money.
How big is this group?
This is, if you look at the very top, it says average employees, 189, 190, right around roughly just under 200 employees.
200 employees, and they were saving hundreds of thousands of dollars.
Hundreds of thousands, and I think we've still continued to keep them on track, and I think they're close to over $2 million in savings now.
Wow.
Oh, more importantly, they haven't had a benefit change, and they haven't had a contribution change. So if you can find an employer that I can show you over the last 7 years that hasn't done that and saved hundreds of thousands of dollars, fully insured, you'd be hard pressed to find them.
You know, you do bring up a good point. We're good with that slide. Thank you. What's interesting is you said they haven't had a change in the plan design, and I know this year I could be with insurance carrier A this year or next year, and then the third year I get a 20-30% renewal. So what do? I shop it and I raise deductibles or change what the employees pay. Now they have to get new ID cards and the plan changes and co-insurance is different and co-pays are different. Here in a self-insured program, the employer determines, as long as it is qualifies under ERISA and the Affordable Care Act and so forth, the employer can pick their plan design and pretty much keep it consistent forever.
Yeah, in the fully insured world, I call that you're buying silos. Here's a silo of plan. You can't deviate. You might like, well, I like that deductible, but I hate that copay. I like that prescription plan, but I hate it. You have to buy those silos of the rates that's filed with the state that comes with it. What I love about when you're dealing with ERISA and self-insured plans is, you know, if you think about it, the employer is going to take on a level of risk, call it $25,000, $30,000, $50,000, whatever it may be. They're paying $1 to $50,000. They have the flexibility to say, hey, I want to have urgent cares as a lower copay because it makes sense for our population, and I want to increase specialty fee but really lower my primary care fee. They have the flexibility to have the design in their plan that fits their needs, that fits their population, that fits their employees, that really works for them. And that's a beauty of being self-insured, is you do have flexibility to a degree. And every little plan change you make, the rates don't change. You're taking on that risk. So from a stop-loss carrier, they really don't care what you're doing underneath that specific stop-loss level. They care about, okay, how's that plan going to stop for any catastrophic claims there afterwards?
In the beginning, you talked about these 4 quarters, right? So I have the stop-loss coverage, I have to hire an administrator and the network and all these things. So I have 4 quarters. Well, typically the insurance company is all 4 quarters. So 20% increase is 20% on a dollar. Here, 20% increase may only be 20% on a quarter. Which is only a nickel. And so it's really only a 5% increase because I'm not having an increase in these other costs.
A lot of times, you know, we tell people, hey, we got a 12% increase on your stop loss, and they relate it to fully insured, and when we have to convert it for them, say, actually, that's a 3% comparable on a fully insured rate. And then when they understand that, they're really happy with it. So
now, one of the things, a couple of key points here. When, let's say, the year goes by and I have this really sick employee and they're still on my plan, can the stop-loss carrier, the reinsurance carrier, come back and say, we don't want your risk anymore because this person is too much, or for the group, we're going to give them $50,000 per person, but this one person, it's $200,000.
Yeah, they call that a laser, and I think the term that we hear the reinsurance stop-loss carriers use is, you know, we provide stop-loss for the unknown. One of the examples they'd like to use is you can't buy fire insurance on a burning building. So the example that you use is, well, what if you have somebody in your population that year after year they're sick, and year after year they're sick? Well, we're only collecting so much in premium to protect the unknown, and if that's a known risk and it's going to take up half the premium, then we're going to laser that individual at a higher level. And that can become scary with some self-insured programs out there. The good thing is there's a couple avenues you can go. Today you can buy stop-loss insurance that's called non-laserable, which means they can't laser out individuals. You pay a higher premium for it, but it gives you that protection to do so. The other way to do it is to mitigate that risk is there's captives. Captives are self-insured, like-minded employers that come together and say, hey, we're going to share that risk pool together, and in doing so, they're able to lower that premium and not have lasers for those catastrophic ongoing claims.
So is that like a MIWA, like a multiple employer welfare association, or is it different?
No, it's completely different. So, and you know, captives have also come a long way. This is captives that we're talking about are owned by the employers that are participating in it. They hire a captive manager to make sure they're managing all the risk. They're coming together and they're sharing. The one portion of it would really be the stop loss, but what becomes more empowering under a captive scenario is, well, not only are we sharing that risk, but we're collecting all the data. So how do we, by collecting all that data, use that to be able to negotiate better deals? And for example, it could be with carriers, it could be with administrators, it could be with PBMs, which is a pharmacy benefit manager, and their prescription plan. We want to use all of our data to negotiate the best deal and the best language for our contracts. So these captive programs that are put together are a way that you can go in, and I call it, I use it for the smaller employers. I use it for those employers just under 500 lives all the way down to just under 100 lives, where they want to put their toe in there. They're nervous about the volatility that could come with self-insured, but under the captive, a lot of that volatility is now off the plate because they're able to control their stop-loss premium, get more data, and they're able to have the buying power of a much larger employer.
What happens if my employer says we're doing self-insurance? Obviously, they're looking at claims and expenses and all this different data on a monthly or quarterly basis. Doesn't my employer have access to now all of my medical information?
So now we're going down the road of HIPAA, and the good thing is you think, oh, I don't want my employer to see my claims. All of this is protected, and the same HIPAA laws that apply on fully insured are applying on self-insured. You're going to have a HIPAA officer that's going to be able to be assigned. They can't have anything to do with HR, hiring, or firing. They're able to look at that data. So the principals in HR, they're able to see claims. They're able to see what's going wrong or what's going good in claims, but they're not able to go down and look at the individual by saying, oh, that person's really sick, and know who that person is. So there's still that protection that goes along with being self-insured. They just have a lot more data that says how their plan is running. So they're able to see the ingredients without the name.
And these plans are eligible for COBRA continuation if an employee leaves?
Absolutely.
Oh, as long as they have over 20 employees?
Yeah, absolutely,
And do these self-insured plans, can you put in an HSA or an HRA or a medical reimbursement program?
Yeah, just because you go self-insured, you don't have to lose the power of an FSA or health savings account or health reimbursement account. A lot of times health reimbursement maybe not makes sense since the employer is already self-funding the claims, but we still have self-insured plans that do that. And we definitely have a lot of plans that they're doing the health savings account, so they're able to still take advantage of that portion of the plan.
Interesting. Now, what happens with contract terms? Like I hear these things 12-12, 12-15, 15-12. What do those mean?
You're doing a great job for a commercial for us. It's a lot. When you talk about self-insured and you have different contract terms and you have to hire an administrator and have to go out and fire the right network to do that, it becomes a little overwhelming. And that's really where we come in and we lay the groundwork for them. What you're referring to is contracts, okay? Claims incurred in 12 months, paid in 12 months, incurred in 12. Remember in the very beginning I mentioned there's that claim lag. They usually don't see it. Well, you want to make sure if you're stepping into that program that you have a contract that allows you to protect you on the back end, which means, hey, I'm in 1 year. This isn't for me. I want to go back to fully insured. When I walk away, I want to make sure that the claim lags are covered under the stop loss and the aggregate coverage. So it does get a little tricky in regards to terms, and that's really where a consultant comes in and says, look, based on your plan and your experience, here's the first year for you to buy it. Until you're comfortable, we'll look at some other terms, but this would be the smartest way for you to buy year one.
Well, we're running out of time for today's show. Definitely want to have you back. I say that to every guest because these topics are amazing. But no, this is great conversation. But this can be very confusing. It's not like, oh, okay, I'm going to go to an insurance carrier and have a health plan. Here I can save a lot of money, especially if I'm over 100 lives. It sounds like that would be the right size group. Can you tell the audience how they can get in touch with you if they have any questions, or if an employers have any questions about how this all works and how Katz Pierz can help them?
Sure. We're, again, a local brokerage firm right here in Cherry Hill. We're Katz Pierz, Cherry Hill, located locally. I can be reached at Shay, S-H-A-Y, at Katz Pierz, K-A-T-Z-P-I-E-R-Z.com, or we can be reached at 800-886-5757.
And Katz Pierz, they've been around for
over 30 years.
A long time. Yeah. Well, Shay, thank you for coming out today.
Thank you, Rob, for having me. I really appreciate it.
We'll see you next week on We Got You Covered. And just remember, if you have an opportunity, please pay it forward. See you next week.